Hello, I'm Brian Scott-Smith for World Risk and Insurance News. Welcome to the RIMS 12 Debrief. This special edition of RIN TV looks at major topics discussed at the RIMS 2012 annual conference and exhibition. You'll hear directly from industry executives, thought leaders and session moderators in interviews conducted at the RIMS conference in Philadelphia. In this report, we focus on two surveys released at the conference, the 2012 Excellence in Risk Management Survey published by Marsh and RIMS, and the Risk of Finance Manager Survey produced by Towers Watson. All this and more, you're watching the RIMS 12 Debrief here on RIN TV. According to the Excellence in Risk Management Survey, there remains a gap between risk managers and senior leaders on the role of risk management, whether it should be primarily defensive or be more anticipatory. More than 1,300 risk managers from some 50 countries responded to the survey. Most risk managers and senior executives agree that expectations of the risk management function have increased in recent years. While C-suite executives expect risk managers to be more involved in strategic planning and to lead ERM activities, risk managers think their priorities are more related to operational issues. I spoke with Brian Elo from Marsh's Global Risk Management Division and Noel Seaman from the University of Saskatchewan about the report they presented at RIMS in Philadelphia.
Well, I think this year's survey really focused on what the gap is between what the C-suite's expectations are of risk managers and where risk managers add value to their organizations. And I think the most surprising thing for me, which is really good news for most risk managers, is that the C-suite really recognizes the inherent skills and capabilities of risk management. And what they're really asking for is move into the gap, move into the fray, get involved more broadly with respect to the strategic opportunities of the organization.
The traditional risk manager focused a lot on operational risk and insurable risk, and perhaps the answers could be reflective that there is still a lot of risk managers where that's the focus.
Well, I think we've seen a continued moving towards analytics driving decision-making frameworks for organizations. I think what you're seeing now is a move towards really understanding what are the insights that data can bring to us as an organization, and how do we marry up the quantitative and the qualitative components of risk.
I would think it suggests that there has been a lot of work on the implementation of enterprise risk management in organizations. Indeed, it seems to show that if you haven't implemented an enterprise risk management system, or by any other name, an integrated risk management system in your organization, you're probably not in the majority, you're probably lagging behind. There's a lot of profile in the media when there is a cyber attack. Organizations realize that it's more than just a cyber attack, it's your reputation at stake, your ability to safeguard information.
We're in a transitional insurance market. The markets are definitely under some pressure from a profitability standpoint. We're seeing some movement in certain areas, and I think that as those movements become more prevalent, risk managers and brokers and others are going to be looking at how does risk finance efficiency actually look, and how does the cost of insurance capital compare against the use of own corporate capital. And I think you'll see a lot more work going on in that world over the next 12 months.
In its third annual Risk and Finance Manager Survey, Towers Watson examined how North American companies use outside resources, tools and frameworks to address risk. Some of their findings: more than half of respondents have an ERM program in place. Nearly all are concerned about the hardening P&C market. 22% are not aware of the changes in property risk modeling, and a surprising 72% have not purchased network security, privacy, liability policies. We spoke with Craig Nelson at Towers Watson, and here is what he had to say.
2011 was a very difficult, challenging year in terms of catastrophe losses, the impact on the industry, the property markets, the reinsurance markets as well. And then the second major reason is the RMS 11 change, and that's catastrophe modeling. So it really is impacting those folks that have catastrophe exposed properties. They're feeling the pain more than others. I think the survey in this particular area is more of an affirmation of that it's a shared problem, and I think that the takeaway for them is that they must be more analytical in their approach to the property market. It's not as simple as just going to try to find another market to try to get a less expensive premium. You have to be able to analyze your risk more effectively than you ever have in the past. You have to be able to have your negotiations with the carriers on a much different level than you have in the past in terms of being able to understand cap modeling, how it's impacted your risk, understand that cap modeling is not an exact science, and therefore being able to understand weak points in it that maybe don't represent your risk as well as it needs to be represented to the carriers, and have that kind of dialogue with the carriers to be able to impact your premiums. And it all starts with understanding your risk and understanding what the modeling does, how it impacts your risk, how it impacts the layers of your program, the structure, the retentions that you take, whether to use your captive if you have one, to deploy some of that capital towards your placement. And so again, being really strategic in your approach to the market before you are even in the market. You know, the cyber world is such that no matter what you do, you think you have the safest environment. Something is always changing. There are folks out there 24/7 trying to figure out ways to circumvent the best of the best in terms of protocols and hardware and software. So yes, we do think that there's still a need, despite all of that, for insurance protection for catastrophic loss that can happen. I think network risk management is obviously here to stay. There's so much that relies on networks now. Business can't run without the network. It is risk management of the future, and being able to understand that, deal with it effectively, get the right risk mitigation strategies, but also the risk financing strategies in place to handle it properly are definitely the wave of the future.
For more of our interviews with these and other industry leaders, visit our on-demand library. In our next World Risk and Insurance News report, we'll have another RIMS 12 debrief, including interviews with leaders from Willis, Ironshore, Chartis, Integro, Star and Lockton, all discussing insurance rates. We'll also have highlights of our discussion with Arthur Koretzinski about the Marsh Captive Benchmarking Report. Well, that's it for this edition of RIMS 12 Debrief. I'm Brian Scott Smith. Join us tomorrow for more World Risk and Insurance News here on RIN TV.